And it's great to have you join us on another edition of Business Capital Market, our only weekend business program right here. I'm Ladi Williams. It's time to take a look at how your money performed this week and get a sense of what to expect next week. But let's begin with a quick review of global stock markets we track. I would say major bourses around the globe ended Friday's trading session mostly mixed as traders assess major data and interest rate comments from the U.S. On Wall Street, the markets closed the day in the green with the Dow up 300 points, but registering the worst week so far this year for the S&P 500. It was about 1.11%, while the Nasdaq Composite gained 1.24%, as traders cheered a stronger than expected jobs report and looked past a jump in rates. In Europe, the indexes closed slightly negative, with the UK's FTSE 100 index down 0.81%, while Germany's DAX dropped 1.24%, while the France's CAC index closed today in the red more than 1%. And across the Asia-Pacific region, Japan's Nikkei led the losses recorded by indexes within the region, as the markets indicator fell nearly 2%, while China's Shanghai Composite at a loss by 0.18%, while Hong Kong's Hang Seng Index ended Friday slightly lower. And back here in Nigeria, the NASD OTC securities markets performance ended the week negative, as the index fell by 2.15% week to date, while the market's overall value dropped by 1.14%. At the same time, the volume of securities traded this week fell by 97% to 868,741, while value traded was up by 81.91%, while the number of deals carried out was 55. Top advances for the week, Afriland Properties and Friesen Campina, while the top decliners are Central Securities Clearance System, which also emerged as the most traded securities, and we see Aradol Holdings PLC. And the domestic stock market ended the last trading week of the last trading week that was of March. No thanks to profit taking on some bellwether stocks. As a result, the market's main index fell by 1.08%. We see April kicking off quite bearish. Now, the first week of April is quite bearish for the market. We see 38.3%. That's the year-to-date gain. We see sell pressure was evident across Tier 1 banking stocks, with FBNH, GTCO, Axis Core, Zenith Bank recording declines. Furthermore, profit-taking activities in MTN Nigeria contributed to the overall market downturn. Despite the overall market decline, activity levels surged, with the total traded volume and value increasing by 104% week on week and 11.2% week on week. QTix PLC topped the list of 31 gainers with a 22.69% price appreciation, while FBN Holdings led 41 other losers, down by 14.21%, while the trio of Abe Mortgage, Tourist Company of Nigeria, and Zenith Bank were the top three contributors to about 3.68 billion equities traded this week. All right, time to review the equities market. Kicking off the second quarter on a bearish note, let's take a look at how Q1 performed. Join us now is Mr. Andy Saku, equity trader, Capital Care Trust. Great to have you on the show. Good evening.
Good evening, Larry.
All right, so the equities market year to date, the first quarter was about 39.84%. That's for Q1 2024. And equity investors, you see data showed they gained about 18 trillion. That's in the first quarter. Not a bad performance. What would you say drove this?
All right. What a year to begin 2024. And I think rightly so, a leap year. And so what we've seen in the first quarter is basically the equities market taking, the market truly by the storm and weathering through against all headwinds, and if you like, tailwinds inclusive. So what we did see basically over the 3 months past is that each of those months has some historic moments. I dare say that in January, we had the first push of the index going and attaining a level of 100%, 100,000 index level. We had never seen that before. So that was the first record to be set in this leap year 2024. The second was in the month of February, precisely February 16th, when the index crossed 105,000 basis points. And that truly is phenomenal. Now, if you juxtapose that with what happened in 2022, which year, basically offered about 19.8%, and then you come to 2023, that offered us slightly over 45%. Interestingly, the months of January up to March seem to have provided, the kind of return that we enjoyed in the whole of 2023. So if you like, you can actually say that, within the first quarter of this year, investors in the market had more than gained a sizable chunk of what the whole of 2023 offered. Now, so coming back to what were the key drivers, one of it, obviously, is the fact that the economic policy of the government began to show some signals of recovery and a bolstering of investor confidence. You will recall that even at the international scene, we noticed some kind of renewed interest and patronage, from investors, even though in terms of, foreign portfolio investments, we are yet to see any significant impact on that. But however, we've seen some political stability that seemed to have given some encouragement to investors. I dare say that the local investors, have in the market by the storm, if you like. We have continued to see their participation in incremental value and volume in excess of 80% of the entire spectrum of the market. So by and large, there is an increased confidence in the market. Secondly, the market has proven over the few years past that there's something you can garner out of it. And that's largely, taken out of the fact that returns have been very, very comparatively advantageous for the equities market. And juxtapose that also against alternative investments. You are not likely to have had any such record in many such other alternatives.
All right, I guess most investors trying to beat inflation at this time. But talk to me about sectors that outperformed in the equities market in the first quarter.
All right, so you will recognize one of the key sectors that provided so much momentum to the market is the industrial space. The likes of Dangote cement pulling its weight, and in the industrial sector also you had the likes of Ball Cement, pulling their weight. And when you move to some other sectors, the consumer goods space, for example, Ball Foods was a key driver. As a matter of fact, Ball Foods contributed over 96% within this period to stakeholders, while Dangote Cement also did sell. Variable power, which came to the market towards the tail end of last year, is a key driver also of this performance, having rewarded investors with excess of 150% within the same period. The likes of, low cap stocks, Veritas Capital in the insurance sector also made the list if you want to judge on the basis of top 10 performers. Transcorp, National Corporation, that's Transcorp itself, also did very well within this comparative period. The lackluster name insurance that for some years had remained in the woods also made the list, also rewarding investors handsome with close to 60% within the period. DN Mayer, or Mayer as it's called as of today, also makes that list of the top 10. So by and large, what I've tried to put out is the fact that the sterling performance you saw in Q1 were basically driven across sectors. But I must also say that while some companies within this identified sector did very well, you cannot say it was all or whole for each of the listed companies in those subsectors. So what that also means is that individual performance of entities can actually determine the size of profitability or the attraction that the market enjoys. That you're in a sector is not guaranteed you will weather.
Right, quite interesting. Definitely, I've seen quite a few stocks there pulling most of the weight, in the market. Well, we know investors in global equity markets are eager to know when central banks will begin, rate cuts. I'm not sure we can think about rate cuts in Nigeria at this time with sky high, inflation. But are domestic equity investors worried about this 600 basis points hike that we saw in the first quarter of 2024?
By and large, speaking to the books, you will expect that every time there's an interest rate hike, equities should tend to win. That's speaking to the books. But the reality also does not always play out that way. If it were, then we wouldn't be at where the equities market is at the moment. It might interest you to know that the very day that the central bank announced the hike, the equities market went up. That's explicitly is a testament to the fact that, yes, there are generic rules for specific exceptions. And to that extent, what investors actually are looking forward to is consistency of results, performance, and rewards. And therefore, to that extent, one of the key, push for the equities market in the last 3 years has been the sterling performance of actually the listed companies beyond the issues of the economy. Inflation has been galloping, and we have all seen it. But somehow, the companies that are listed have been able to weather through. They've been able to ensure that their performance has not by any way declined. And that's a testament to the future of the market, given the fact that the performance of the company is actually what keeps us on board. Yeah, inflation has been rising by leaps and bounds, but interestingly, the equities prices have also weathered and been able to reward investors beyond the negative inflation impacts.
Quite interesting. But, well, since Q1 is over now, what are you seeing for the second quarter, and what sectors do you think is time to either sell, hold, or buy going into the second quarter of 2024 trading?
It would be very interesting to, pin to a sector and say sell out of this sector or get into this sector. But those are investment decisions that you can always, garner out of your stockbroker, right? But let me speak from a generic perspective. The key drivers and the sectors, like I said before, will continue to maintain their poise in the market. There is nothing at the moment to suggest that companies' performance are likely to dwindle. We are in, earnings release season. We began to see some numbers. AGMs are being called upon or are already being held for the release of Q1 numbers for this year. I do not, by any streak of imagination, think that the numbers will generally be bad. However, there will always be those who will be below the waters. And, and as to the investor, will be careful to watch over his specs wherever they are, so that you are not caught napping when you ought to be watching and possibly praying.
Quite interesting. Thank you so much. Always great having your perspective, Mr. Andy Ishaq, who's a stockbroker at Capital Care and Trust. It was great having your perspective, and let's hope it's a profitable second quarter.
Always my pleasure, Laddie.
All right, it's time to look at the fixed income market. Now let's take a look at the performance in the first quarter and what to expect for the second quarter of 2024. Join us for this conversation now is Tobechukwu Ikpe, fixed income trader at Access Bank. Great to have you on the show. Good evening.
Good evening, Laddie.
Fantastic. So we see the total subscription for the first quarter of 2024. That's about 21.17 trillion naira. Big number there. How does this compare to previous quarters or years in the fixed income market?
So we've seen a lot of interest in the first quarter of 2024. This is due to, as you know, the central bank policy of raising interest rates. So those interest rates have been very attractive to all sorts of investors. We've seen the increased participation from the local investors, from the institutional investors, and the key one here is the foreign portfolio investors. A lot of interest from them. We've seen them inflow their FX into the market to purchase these fixed income securities at elevated interest rates, and we can see there's a testament to that in the appreciation of our FX rates. However, this increased participation has increased the subscription levels at the primary auctions from an average of 900 billion per auction last year to over 1.7 trillion this year. That's at the Treasury bills auction. We've also seen robust appetite for the bond auctions this year as well. So lots of participation, lots of interest, people looking to take advantage of the elevated interest rate. The central bank has said they are going to target inflation as their primary mandate. They are looking to bring that down and generate a positive carry in terms of the interest rate environment. So currently the carry is still negative. The last inflation numbers printed at 31.7. The real yield at the auctions for the 1 year treasury is around 27%, 26 point something, depending on which of the auctions you use. So they are focused on that, and a lot of investors looking for how to protect their wealth from this galloping inflation that we've seen. So the figure you called there, the subscription levels, unprecedented in Nigeria's history. The interest rate levels also unprecedented. We've seen bonds issued at 20% in Q1. The subscription levels for the total sales, I beg your pardon, for Q1 across all fixed income securities, the Treasury bills, the OMO securities and bonds stands at 10.7 trillion. And compared to Q4 last year, where it was just 4.2 trillion, and Q1, again comparing against Q1 in 2023, it was 3.5 trillion. So we've really seen an increase in the supply of these fixed income securities to the market.
Yeah, quite a big number there. And just, for the Naira defense alone, we see data showing that it's going to cost the central bank about 1 trillion Naira in interest rates from all the auctions we've seen, in the first quarter of 2024. I'm sure that's bigger than what, we've had in the previous quarters.
Yes, it is way bigger than whatever Nigeria has had in terms of raising these funds. Part of the issue, yes, the central banks promised not to exceed their ways and means target. So no more ways and means to the federal government. So the federal government has had to come to the market to borrow these funds, which has led to increased allotments, increased interest rates. We've also seen, speaking to debt service costs, last week there were comments by the Minister of Finance where he said if there's anything that keeps him up at night is the debt service cost of Nigeria. So although the interest rates are high, they have to keep an eye on the servicing costs. It's quite enormous to be funding a 10-year bond at 20%, 19% levels. Those coupon payments are going to be hefty as the years roll by. So they are looking for ways to fund the budget outside these auctions. He said they're looking to raise a domestic FCY bond later in the year. So we'll see how that goes. They said they've hired some consultants looking into the possibility of that. So those domestic FCY bonds compared to the regular Euro bonds will be funded by local domestic investors with their FCY in their bank accounts. So unlike Euro bonds where these foreign banks are largely investing in those Euro bonds, they're looking to tap into the DOM balances that are available with Nigerian banks. The latest figures are over $30 billion. So if you have some FCY and you study a way to protect your Naira from the depreciation that witnessed throughout late last year and some part of this year, they're going to offer you some interest rates on those as well later this year.
Right. I guess investors have a lot to look out for this year in the fixed income market. But looking at the types of, fixed income securities, have the government bonds, corporate bonds. But we see data shows only about 32 commercial papers were issued in the first quarter of 2024. I guess government short-term securities are getting all the action, at this point. Is the government borrowing already crowding out the private sector, at this rate?
It definitely will. I mean, government securities are seen as safer than lending to a corporate because the government usually has the ability to pay back compared to the corporates. But another factor is also the level of interest rates. You will not see corporates raising bonds at this time because the interest rates are quite high. It's going to be a lot of cost to them. Imagine a manufacturing company borrowing at 20% where they don't want to sell their products. So a lot of them stick to the short end. So those that can refinance their CPs, the commercial papers, they usually do so, but at elevated levels. Last year, a lot of them were able to raise the CPs at 15 to 17% effective yield, but now they are raising at 22%. So it has affected them in terms of their borrowing costs also. So the reason you saw that reduction in commercial paper issuances is also because the lesser known names might not be able to come to the market to raise those funds, like last year where people were hunting for attractive yields in the low interest rate environment. So the people we've seen do that this year are the popular ones like Flour Mills, Dangote, Dufil Prima. Those blue chip companies have been the ones that are able to tap that market because people are still a bit comfortable with them to be able to give them short-term funds. So the corporates largely are sticking to the short-term funding market now, commercial papers, 180 to 270 days to refinance their obligations. The lesser known names have no choice but to wait it out and see where they can get the bridge funding from.
Right, it's all about looking for funding, at this time. But we'll see from the MPC meetings, we've had so far, and we've got about 600 basis points from the two meetings we've had, this year. Is it safe to say, going forward and looking at the level of inflation and still on the rise at this time, is it safe to say every meeting, we have this year is going to basically favor the fixed income market?
Well, it depends on your position at the time of the meeting. For now, they are bent on tackling the inflation and also attracting FX. So if the inflation numbers keep going up, we might possibly see continuous hikes in the MPR till the inflation comes down. But they also have to be careful, as we mentioned earlier. They also have to look at the cost of servicing this debt. If those interest rates get too high, it may also backfire and be a burden for them, and no one wants to default on their obligations, especially the government, because that would have negative consequences for the country. So they will keep an eye on that, look how to tackle inflation, but they also have to remember that the fiscal side has a lot to do. Some of this inflation is also structural, or we see the removal of subsidy come into the inflation numbers early this year. So as the year progresses from end of Q2, beginning of Q3, we see that base effect drag those numbers down. But we also see them removing electricity subsidy recently also, which will further push inflation up. So it's a delicate balancing act for the Apex Bank. They have to be able to balance trying to rein in inflation while also not shooting themselves in the foot by jacking interest rates too high in the country and grinding the economy to a halt.
Yeah, definitely a serious balancing act that has to be done there. You did mention the electricity hike recently. That also will feed into inflation actually going forward. So it's really quite a tough one, I must say, for the Apex Bank. But what are you seeing going into the second quarter, of 2024? What are you seeing for the fixed income market?
For the fixed income market for the second quarter, what we see is the same as the first quarter. We see the elevated interest rate environment to continue as the inflation remains elevated. Last figures are above 31%. So until that inflation starts to trend downwards, we might not see a reduction in interest rates. We also see tightening of the money supply. Nigeria's CRR rate right now, which has the cash reserve ratio, the amount of money that banks have to set aside with the central banks, is at 45%, which is, if not one of the highest in the world, if not the highest. So we've seen a tightening in money supply, which means it's basically harder to borrow money since the central bank has taken all that money out of the banking system. The cost of borrowing has increased. So we'll continue to see this elevated interest rate throughout Q2, or maybe we will continue to Q3, depending on how the inflation numbers print going forward. But optimistically, we expect that by Q3, we should start seeing inflation numbers coming down, and hopefully the interest rates also coming down as well.
All right. Well, I guess we can't wait to see those inflation numbers actually come down, counting down to Q3, as you said, to see that happen. So thank you so much, Obechukwu Ikpe, fixed income trader at Access Bank. Thank you so much.
Thank you for having me, Ladi.
All right, so that's it. That's how your money performed in the first quarter of 2024, and that's the outlook for the second quarter. I do hope you make profit, going forward into this second quarter. Thank you for watching. I'm Ladi Williams. Enjoy the weekend. Bye-bye.